Welcome to the Other Side of Wall Street with your host, Ron Harrison.
Good morning, everyone. Welcome to the Other Side of Wall Street. My name is Ron Harrison. I'll be your host again today. And if you've been tuning in the past few episodes, you'll know that we've actually started getting into specific option strategies. And even more specifically, these strategies centered around the selling of options, which, as you know from earlier episodes, that is our main go-to strategy. Now, if you had tuned in, you'll know that we covered already we compared four basic strategies. First being the buy and hold, which is not what we do, but we wanted to compare everything else against that. And then we looked at selling covered calls. Then we looked at selling covered calls and purchasing leaps. Then we looked at selling naked puts. And once we kind of had an overview of those three, what I wanted to do then was delve into each one of those in greater detail. So the second half of last week's episode, we started in and talked about the naked puts. And this week, what I'd like to do is look at the strategy of purchasing leaps and selling covered calls. So with that said, and of course, if you missed any of those episodes, I strongly suggest that you go back and listen to those, because each week, again, we try to build a foundation on the previous week's episode so that we keep going. Remember, I said in the beginning of these shows that I want this series to be kind of like a book, to where each week is another chapter. So as opposed to jumping into the middle of the book and starting reading, it's always better if you start from the beginning. So the farther back you can go, the more foundation you'll have, and the more all of this will make sense. So anyway, today's topic, again, purchasing leaps and selling covered calls. So why a leap, you may ask? Well, a couple things. It's going to award you with capital preservation. Number two, if your covered call gets exercised, a leap is going to provide far more options for profit than, of course, if you outright own the stock. And number three is it's going to be a higher percentage return on your trading capital, which is something I think we all would like to have. So first off, capital preservation. So again, we're making up prices here. The stock price, let's say it's $13 a share. And you might find a leap option which you could buy for $7 per share. So what that would do for you is you could benefit from the price movement for around half the price of the stock, which means that you can now control almost twice the amount of shares of stock that you would have if you had actually outright purchased it. So you could either spend the $7 and save 50%, own the same amount of shares, or you could spend the same amount of money as you would for the outright purchase and actually control twice the amount of shares. Either way you wanted to go. So let's see what's happened so far in our account, our fictitious account. So stock XYZ, let's say it's trading at $13.20. And let's say you purchased a March 2020 $5 leap for $7.12. Then you turned around and sold a $13 call, which is the covered call part, for 12 cents a share. So the current debit for this position is $7 per share, which was the $7.12 we purchased minus the 12 cents we collected in premium, $7 per share. And we now control XYZ, currently trading at $13.20 for $7 per share. And we can continue that until March 20th to 2020, or until March 2020, I'm sorry. And that's when, of course, our leap will expire, and we could either roll that at that point or make some adjustment to it. But as it stands now, we're good until March 2020. So what happens if you're exercised on your covered call portion? And that is if the stock closes above the strike price of the covered call you sold, which, by the way, was $13. So first, if you are exercised, your account will be short the stock. So this means that you will sell the stock, and by the way, a stock that you currently don't own, and the result will be cash deposited into your account equal to the strike price of the call option you sold times the amount of the options you sold times 100 for each option. So now your new obligation will be to at some point replace that stock into your account. And you do that by purchasing stock at a lower price, ideally, and thus keeping the difference, which is always the goal of shorting stock. But your account has now been credited, let's not forget this, $1,300 cash for each option that you sold. So on a per share basis, you spent $7 per share to put this position on. You've just taken in $13 per share from shorting the stock, which leaves you with a net credit of $6 per share, or $600 per contract. Now, what options do you have here to replace this stock? And I'll give you a hint. You have 3. Option 1 would be, as we all know, we still own the LEAP, and that LEAP gives us the right to purchase a stock at a greatly discounted price, which if we exercise the LEAP and replace the shorted stock, we will in most cases realize a nice double-digit return. And remember, this was your original play that we used to make the decision to put the trade on in the first place, so by doing this, that is basically following the plan. So account status if you take option 1. So if you were to exercise your LEAP, you'd be able to repurchase your short XYZ stock for $5 per share. This would give you a return of $1 per share, or a return of approximately 15%. But now there's option 2. Let's look at that. We can, if we want, decide to wait and see if the stock drops below the price that it was shorted at. So if it should drop below that price, then we can opt to purchase the stock at that lower price and keep the difference. So for instance, remember we shorted it at $13. So let's say the stock is pulled back and is trading right now at $12.70. So the difference would be 30 cents. So if we had repurchased the $21.70 price at the $12.70 price, we would keep the 30 cents per share. And this would also, then we'd still own the LEAP and now be able to sell another covered call against it, collect and get another premium. And this would mean that a return for the current month would be the new call premium collected plus the 30 cents we made on the repurchase of the stock. So as you see, these little credits keep adding up, and all the time that's lowering our cost basis and increasing our profit. So now how do you calculate the returns if we decide to go with option 2? Well, you just take that 30 cents and add it to the spreadsheet as an additional premium for the current month that the stock is covered or repurchased. And this will increase our overall percentage return on the LEAP covered call play. Again, things just keep getting better and better. So now before we move on to option 3, let's have a little quiz. You ready? First question, can we now define what a covered call is and what a covered call with a LEAP is? Because we just covered that. I'll give you the answer. A covered call is the taking on of an obligation to sell a certain stock that we currently own at a certain price for a specific period of time. And so by taking on this obligation, we receive a premium or cash into our account. That's a covered call. A covered call on a LEAP is exactly the same, except that instead of outright owning the stock, we own the LEAP instead, which gives us the right to buy the stock for a specific price for a specific period of time. So for this right, we pay a premium, which if you remember is around 50% or less, ideally, of the price of outright purchasing the stock. So now the second question. Now that I've just explained to you what the difference between a covered call and a covered call with a LEAP is, who can define what a covered put is? And I'll give you another hint. This is our option 3. Okay, let's look at it this way. When we do a covered call, we are long the stock. When we do a covered put, we are short the stock. When we do a covered call, we sell a call against our long stock position. So hence, when we do a covered put, we sell a put against our short stock position. So a covered put is selling a put against our short stock position, which is the result of the original covered call in our LEAP covered call trade being exercised and having the stock shorted away from us. So let's examine how this works. So we are short XYZ stock at $13. We have to someday replace that stock. Our hope is that the stock price will fall and we'll be able to buy it back at a lower price than the $13 that it was taken from us at. Then we get to keep the difference. But our risk is that the stock will increase in price and we'll be forced to buy it back at a higher price than we sold it for, and that, of course, would result in a loss. So how do we protect ourselves from risk while still generating a monthly income? Good question. We will want to ensure that we purchase the stock back at a lower price than we sold it for, or than it was shorted for. So to do this while still generating a monthly income, we will sell a $12 put, taking in a premium of 32 cents. This means that if the stock closed at or below $12 on expiration day, we will replace the stock at $12, resulting in a profit of $1 per share. Remember, we shorted at 13, we covered it at 12. That's the dollar profit. But let's not forget the extra 32 cents we collected for selling the put in the first place, which will result in a total profit of $1.32 per share. So if the stock moves down and closes at or below $12 on expiration day, we are assured of making $1.32 per share. Now, in most of our accounts that I deal with, we're usually averaging around 30 contracts per share or 3,000 shares, which will result in a credit, if we were dealing in 30 contracts or 3,000 shares, of $3,960 into our account. Also remember that we still have the original leap. And this is also, don't forget this is also our fail-safe protection for our short position. So regardless of what we're doing by selling the puts, we always have that in our back pocket. We can always exercise this leap in the event the stock price keeps rising. But remember, you now get to add the additional 32 cents from selling the put that you already to the $1 you already make by exercising the leap. Again, a total of $1.32 or $1,300 per option. And remember, you can do this every week. So each week, week after week, you can continue selling puts against your short position, each week bringing in more premium, each week lowering your cost basis or increasing the end profit. And at any time, you can decide enough's enough. If the stock keeps going up, you can decide enough's enough and just exercise your leap. Or you could not sell the puts at all, exercise your leap in the beginning, close the trade out, keep the profit that was built in. But I personally like to keep kind of leading this on because each week that we do this, we're still collecting more premium. And the goal behind what we try to teach and what we do is generate weekly cash flow. That's what we're trying to do. And so you could do that by selling covered calls against your leap. If they end up getting assigned, you're short the stock. Now you can sell covered puts against your short position. But all of that each week is generating cash flow. So that's really the name of the game, is generating weekly cash flow. So again, the name of this game is multiple streams of income because we're getting it going in and we're getting it coming back out. So with that, coming up to break time, let's take a break and we'll be back and talk some more.
Here's another look into the world of trading.
Hey traders, want to jumpstart your trading? Well, I would assume that since you're listening to this podcast that your answer would be yes. And as they said in The Godfather, what if we made you an offer you can't refuse? And that's exactly what we're going to do. How would you like it if we gave you all the trades we make in our own accounts in real time so you could trade right along with us and profit as we do? And what if we met once a week for an hour to discuss our current trades, any other trades you may have open, plus discuss any problems you may be having in general with your trading? And that's 1 full hour of group coaching each week. Also, what if we threw in an additional 1/2 hour of private one-on-one coaching each month to privately work on issues you may be having with your trading? It could be things you didn't feel like sharing in the group sessions. Also, what if we threw in a weekly end-of-week market review analyzing the past week's market and what to look forward to for the upcoming trading week? That will be delivered to your inbox every Friday after market close. And what if we threw in a free copy of our latest book, Reprogramming the Trader's Mindset, to help you get your trading emotions of fear and greed back in control? And what if we also sent you our monthly newsletter packed with trading tips and upcoming market events? That would be very useful, I'm sure. And to cap it all off, what if we gave you a 30% discount on all of our live 3-day trading seminars? So altogether, this adds up to $1,269 in monthly value, plus another $1,680 in course discounts to use whenever you like. And if you think all this sounds good, then you must realize that this is a very powerful addition to your trading business. And as with any business, in the beginning, you will need a mentor or support team to help your business grow and to keep you on track to achieve your maximum trading potential. So the small cost to this extensive package is only $49 per month. And of course, you can cancel at any time, but since you will be making far more than the cost of the program by just copying our trades, we doubt you're going to want to cancel. So don't wait any longer. Sign up today. Go to tradersacademy.org. Again, that's www.tradersacademy.org. And do it soon because memberships are limited. And it's our promise to you that if you copy all of our trades and you don't make at least double the first month what you paid, we'll gladly refund your subscription payment. So join us, and together, let's make some money. Okay, we're back, and we've been talking about, in today's episode, buying a leap and selling covered calls. And hopefully now, as you start listening to more of these, more of our shows, more of our episodes, you'll see that these strategies are, like I said before we took the break, great strategies for generating weekly cash flow. And they work very well. And if you follow our instructions, you'll actually be able to do this with less money than you would have if you thought the only way to do things was buy stock and hold them. So there are many smarter alternatives than what you might think out there for playing the stock market, and that's really our goal, to show you how to do those. So one thing I do want to point out is that with all of these strategies, including even the buy and hold strategy, but any of the ones we talk about, and a lot of the ones we haven't talked about yet, any of them and all of them, there's one component that you want to make sure that you always keep in mind. And that is, when you're making decisions to put these trades on, you need to look at the charts, do your analysis, which, by the way, we're going to get into more technical analysis down the road, actually quite a bit of it. But for now, you just need to do your analysis, look at the charts, because, and this, you may have heard this many times before, it might be an old adage, but it's so true. What you want to do is look at the charts and determine the trend of whatever stock or whatever index, whatever you're looking at. You always need to determine the trend. Now, some of you might say that, yes, but you said that we're practicing non-directional trading. It doesn't matter which way the market goes. And that is true. At the same time, you need to at least look at the charts and know that, is this thing in a strong uptrend? Is it in a strong downtrend? Or is it in a sideways trend? Because that will determine which of these strategies you would want to pick and use. Now, granted, with all of these strategies, there's a certain component that we don't really care what the stock does within a range. That's the trick. Within a key, within a range. So it can move up, it can move down, and it can move sideways. And if it stays within our predetermined range, we will profit, and we will have to do nothing else except wait the time out for the options to expire. But if it would be blind for you to pick a stock that is on a vertical tear up, or that's crashing through the floor on the way down, and try to do a trade like that. So it is important that you identify the trend. So one of the main components of making all of this work is trend following. And again, if you do identify the trend and you do follow the trend, you'll be able to profit in up and down markets. So the thing about trend following doesn't swear any kind of allegiance to a bull market or a bear market. And it follows trends to the end. And no matter how ridiculous trends might appear, no matter how early, no matter how insanely extended they might appear, at the end, you want to follow the trend. And why? Because they always go further than anyone expects, kind of like the market that we're in right now. So you'd have no more buy and hold, no more analysis or news. Trend following decision making doesn't involve any kind of discretion or guesses or gut feelings or hunches. It's not day trading. It's not buy and hope, or in other words, buy and hold. It doesn't involve passive indexing, in and out trading, or day trading, any kind of fundamental analysis. No more 24-hour news cycles or daily turbulence or sensational hype. No black boxes or magic formulas. You can let go of all these holy grails. No predictions. Trends exist everywhere. They're always coming, they're always going, and the markets are no different. They trend up and they trend down, and they also trend sideways. And that said, no one can predict a market trend. You can only react to one. So if you're looking at any kind of indicators, there's no indicators out there that's going to tell you where the market is going to go. But it can confirm very nicely what trend it's currently in. So trend following never anticipates the beginning or the end of a trend. It only acknowledges when the trend changes. So there is no need to figure out why a market is trending. All you got to do is figure out where it's trending and follow it. You don't need to, like in other words, I always like to say, you don't need to understand electricity to use it. So the big money of letting profits run. That's one of the goals. Remember I said before, you want to let your winners run and you want to cut your losers short. Well, if you're following the trend, you have a much greater chance of letting your winning trades run. Trend following at its best aims to compound absolute returns. It doesn't shoot for averages, and the goal is to make the knock your socks off returns, not passbook saving interest. Trend following also has the unique ability to lie in wait for targets of opportunity. That means killing it on unpredictable surprises. And remember, I've talked before about, I think I did anyway, about how if you follow the charts, you're going to know when a trend is changing. And one of my pet peeves always was that back in 2008, if you watched the charts would have told you when to switch gears and when to look at changing the course, which was up prior and then it started heading down. It would have told you when the down move started. So you either could have taken that information and gone to cash, which is what we typically predict in normal situations, and then wait it out and see if the market resumes the uptrend. Or at some point, it would have told you enough information that you said, okay, it doesn't look like it's going to resume the uptrend, so let's go short. Let's start working on trades that take advantage of a downward trending market. But the chart would have told people that. And a lot of these fund managers and money managers out there just rode the thing down and down and down. And that's why all those trillions of dollars was lost to the retail investor in 2008, because nobody did anything. Whereas if you were following the charts and if you were following the trend, you'd been making money. So that's, again, one of my pet peeves, but oh well. So in trend following, risk management is always going to be top priority. So trend following always has a defined exit to control injury to your account. So stop losses and proper leverage use are standard practice. So trend following is also how low negative correlations with most other investment opportunities are. So again, let me say that again. Trend following always has defined exit protocols to control injury to your account. So stop losses and proper leverage uses are standard practice. And again, we talked about that before. Always want to use stops. Trend following also has low to negative correlations with most other investment opportunities. Keep that in mind. Take advantage of mass market psychology. Now, we've talked about mass market psychology quite a bit in earlier episodes. And trend following takes advantage of the panicky sheep behavior. Remember, I talked about herds of sheep. Strict discipline minimizes behavioral biases, and it solves the eagerness to realize gains and reluctance to crystallize losses. And too many people believe what pleases them, what they want. They believe what they want to believe, and they hear what they want to hear. And a lot of people can look at charts and, not knowing what they're doing, they can look at a chart and find exactly what they want to find to substantiate what they want to believe, even though it's not true. Most behaviors are simply driven by impulsive movement of the now, but trend following wins because of that. Because if you're looking at a chart, the chart tells you what's happening right now. That's what you need to follow. You need to follow the trend. Wherever the trend is going is where you want to be. The difference would be, imagine you're roaming around Idaho, let's say, and you come across a rapidly moving small river, stream, whatever. Let's say river, like a white water, like where you'd be rafting. And you're looking at this thing, and the water's moving really well. You could do two things. You could say you want to go for a swim. Well, you could jump in and start swimming upstream against the current, against the movement of the water. Think how hard that would be. Think of how much struggle that would be, if you could even do it, but it wouldn't end well. Or if you could jump in the same river, start swimming with the current. Think of how effortless that would be, and think of how far and how fast you'd get to your next stop, downstream. So trading with the trend is the same way. If you trade against the trend, it's going to be very hard, very slow, very painful in most cases, and most cases it won't work. Whereas if you're trading with the trend, it's going to seem effortless and much easier to profit and have good trades. So again, the trend is what you want. And it's also a scientific approach to trading. So trend following doesn't require a belief, but rather it relies on unwavering scientific principles and has a defined edge, just like, if you saw the movie, the MIT card counting team that beat Vegas casinos. You want to be the casino, not the hapless player. Trend following uses rigid rules rooted in numbers. So think process, not outcome. Remember, frequency of correctness is not the issue. The magnitude of the correctness is what matters. Winning percentage means nothing. Because in other words, what I'm saying is you could have a lot of winning trades, and maybe they're small little teeny trades, and then you have a losing trade that's far larger. Wipes out all the winning trades. So it's not the percentage of winning trades, it is the magnitude of your winning trades, of the correctness of your winning trades. And by following the trend, you have a much greater chance of making those magnitude levels much, much, much greater. And trend following also has a strong historical performance in crisis periods. So trend following is adaptable to differing climates and environments, performing best during periods of rising volatility and uncertainty. So the unknown will happen again. Trust me, I promise you, it will happen again. So are you going to be ready? You have to be able to ride the bucking bronco, ride the storm out, and stay alive. Again, trend following will keep you in that groove. And again, as I said, farther down the road, we're going to talk about technical analysis and how you can actually use certain indicators to make sure that you're always following the trend. And no traditional diversification, trend following is not restricted to any single market or instrument. So a focus on price action allows trend following to be applied to an exceptionally large variety of markets. So price is the one thing that all markets have in common. A trading system for the Treasury bond should also work for the euro as well as for stocks. And remember, I said price action, and I've always told people that technical analysis, the cool thing about technical analysis is that everything known to man about an individual stock, about an index, about a future, about a currency, everything that is out there that is known is already priced in to the stock. So when you look at a chart and you look at the price, everything is already priced in. So there's nothing left for you to dig up or to understand. So if you follow the price charts, follow the candles, follow the indicators that you're using, that is all you need to know to follow the trend. There's nothing else out there you need to dig up. So it kind of simplifies the whole thing quite a bit, actually, in my opinion. So again, price action is the one thing that all markets have in common, and a trend trading system for Treasury bonds should also work for euros, stocks, futures, anything. That's why it's such a perfect way to construct your trading plan. And of course, you're going to have no government reliance. Forget Social Security bailouts, stimulus plans, roads to nowhere. Those won't help you make money. They'll only help you lose money. So when the Fed puts on or takes off training wheels, will you be ready to mint cash, or will you sit there and just take it again? So if your portfolio is grounded in sound principles, you can win no matter what happens. So again, trend following is a critical component. So further down the road in further episodes, we're going to talk about creating trading plans. And a trading plan is something that you're definitely going to have to have in order to profit in these markets. But another reason you need a trading plan is to combat your emotions. And we're going to talk more. We talked about that already, and at some point we're going to get back to it. But a trading plan, just like any other business that goes into business, you wouldn't think someone would open up a store, restaurant, hardware store, whatever the business would be, without some kind of trading plan. The bank wouldn't lend money to open a business without seeing a business plan. Well, trading is no different. You can't expect to make money in this market with all the variables out there without some kind of plan that will tell you, and because this is created by you, so it's you telling you how and when to enter a trade, how and when to stay in the trade, and how and when to exit the trade, and all the parameters that surround those decisions. So again, a critical component of your newly formed, or one you will be forming, trading plan will be to incorporate trend following. And that will also, of course, be involved in learning how to read charts, technical analysis, because that is the only way to determine a trend. So all these things are going to fall into place. And again, future episodes, we're going to cover each and every one of those, and plus many things I haven't even mentioned yet. So all these pieces are coming together. Each chapter of the book is unveiled each week, a new chapter. So stay tuned, stick with it, and we're going to build a very, very solid foundation that will allow you to profit no matter which market you decide to trade. And hopefully each week, as we add a new piece to it, it's going to start shaping up, and you're going to start seeing the bigger picture and how all of this will work together. And also, if you want to jumpstart that and you don't want to wait week after week after week, you can always go to our website and sign up, www.tradersacademy.org. It's tradersacademy.org or .org. Go there, sign up, and you can really fast track this whole thing and get going much quicker, or just keep coming back each week and we'll keep giving it to you 1 week at a time. Either way, we're going to be giving it to you. So hope you enjoy it, and hope that's going to help you profit, which I know it will. And remember, our goal is to increase your profits and lower your risk. So again, website is tradersacademy.org. Check it out. And otherwise, we'll be back next week and we'll do it again. So thanks, and see you then.